October 29, 2025, the sun rises on a world holding its breath. In the heart of every major financial center, anticipation hangs in the air like a thick fog. Today, the stakes feel higher than ever. The world of finance is on edge, waiting for the U.S. Federal Reserve's next move. Every headline, every whisper, every rumor is dissected for clues about what's coming. Markets everywhere are split, bulls and bears locked in a tense standoff, each side convinced the other will blink first. The uncertainty is palpable, and no one is sure who will come out on top. Investors are glued to their screens, scanning every chart and headline for a hint of direction. But until the Fed speaks, it's all speculation, and every second feels like an eternity. Europe's stock 600 dipped 0.1%. Not a crash, but a sign of nerves. Even the smallest movement is magnified in this climate of anxiety. US futures? Flat. The market's in a holding pattern, waiting for direction. Traders are hesitant to make a move, knowing that one announcement could change everything. In Asia, it's a mixed bag, each market responding differently to the uncertainty, reflecting the region's unique pressures and hopes. Hong Kong's Hang Seng fell 0.5%, Japan's Nikkei rose 0.7% as investors react to both local and global signals, trying to read the tea leaves. And China's Shanghai eked out a tiny gain, a sliver of optimism in a sea of caution. No single narrative, just global uncertainty. Every market tells a different story, but all are bound by the same sense of unease. Every region has its own worries. Europe's sluggish growth, Asia's export jitters, and the ever-present question of what comes next. America's big question, party over or one more dance? Is this the end of the rally, or just a pause before another surge? This divergence is the story. The Fed's decision isn't just about the US, it's the world's headline. Every country, every investor is watching for the ripple effect. The global financial system is bracing for impact. The tension is almost physical, as if the world is collectively holding its breath. From London to Tokyo, every trader is watching the Fed. The outcome will shape portfolios, economies, and perhaps even the course of the year. The scoreboard is a patchwork of red and green, a visual reminder of the world's divided expectations. The tension is thick, the stakes are high. Every decision, every hesitation could mean millions gained or lost. The Fed's move will ripple across continents, affecting currencies, commodities, and confidence from Wall Street to Shanghai. Until then, the world waits. The silence before the storm is almost deafening. The next chapter hinges on a single decision. Stay tuned, the world is about to change. Why does the Fed matter to everyone everywhere? It's not just a question for economists or Wall Street insiders. This is a question that affects the daily lives of billions of people across the globe, because the US dollar is the world's reserve currency, sitting at the heart of the global financial system. It's the backbone for international trade, investment, and even the savings of many countries. Most global trade, oil, coffee, you name it, is priced in dollars. From the fuel in your car to the coffee in your cup, the dollar's reach is everywhere. When the Fed raises rates, borrowing dollars gets pricier for everyone, not just Americans. Companies and governments worldwide feel the pinch, as loans and investments become more expensive. A stronger dollar means debts in emerging markets get harder to pay, sometimes pushing countries toward crisis. For some nations, a Fed decision can mean the difference between stability and financial turmoil. US exporters suffer. Foreign goods get cheaper for Americans, and global capital rushes into US bonds. This can shift jobs, change prices, and alter the flow of money around the world. The Fed's decisions are a gravitational force, pulling and pushing economies worldwide. Its influence is so strong, it can set off waves that reach every continent. Every finance minister, CEO, and investor tunes in when the Fed speaks. They know a single announcement can change their fortunes overnight. The Fed's ripple effects shape trade, investment, and currency values. Markets from Tokyo to London react in real time, adjusting to every word and signal. It's the biggest game in town, and everyone is playing, whether they realize it or not. A single rate hike can trigger a global chain reaction, setting off domino effects that can be felt in distant economies and local markets alike. The world's economies are tied to the Fed's choices, connected by invisible threads of finance and trade. No one is immune to the dollar's power. From small businesses to entire nations, everyone feels the impact. The Fed's move can make or break markets, spark rallies, or trigger panics in a matter of minutes. That's why the world cares. The stakes are global, and the consequences are real for everyone. The Fed isn't just America's central bank, it's the world's. Its decisions echo in every corner of the planet. All eyes are on Washington, waiting to see what happens next. So, what's the Fed likely to do? The smart money says nothing. Expect rates to stay at a 22-year high, between 5.25% and 5.50%. The Fed's already done the heavy lifting on inflation. Now, it's a strategic pause. They want to see how past hikes are playing out before making another move. Holding steady is still tight policy. It keeps pressure on borrowing and spending. The real drama isn't the decision, but the words that follow. Markets want clues about the future, not just today. The chairman's comments will set the tone. The market's already priced in a pause. The Fed is shifting from attack to watchful waiting. The next move depends on the data. The world is listening for hints. The fireworks come after the announcement. Stay alert for the Fed's signal. The real event isn't just the policy decision, it's the press conference with Fed Chair Jerome Powell. This is where the world tunes in, hanging on every word, every gesture, and every subtle shift in tone. Every word, every pause, every inflection, analyzed for hidden clues about the future of the economy. Journalists and analysts are on high alert, searching for any sign of what comes next. Investors want to know, is another rate hike possible this year? Or will the Fed finally hit pause and let the dust settle? Or is the cycle over? The uncertainty keeps everyone on edge, waiting for a hint of what's next. If Powell sounds tough on inflation, markets get nervous. A single phrase can send stocks tumbling and bond yields soaring. But if he's balanced, markets breathe a sigh of relief. Calm words can spark rallies and restore confidence. The second big question, when will the Fed start cutting rates? Everyone wants to know when relief might come. Powell won't give a direct answer, but his hints matter. Even a slight change in language can shift expectations across the globe. If he says higher for longer, stocks could take a hit. Investors brace for more pain if rates stay elevated. Powell must walk a tightrope, tough on inflation, but not too tough. He needs to reassure markets without letting inflation expectations run wild. His words will set the market's mood for weeks, shaping everything from mortgage rates to global currencies. The world is watching his every move. From Wall Street to Tokyo, everyone is tuned in, waiting for the next signal. The press conference is where fortunes are made, or lost. A single answer can change the course of markets and careers. Powell's performance is the main event. His delivery, confidence, and clarity are scrutinized like never before. The stakes couldn't be higher. Billions of dollars can move in seconds, all based on what's said, or left unsaid. This is the Super Bowl of finance, where the world's attention is focused and the outcome can ripple across the globe. The Fed's challenge. The U.S. economy is still running hot. Growth hit 4.9% last quarter. Great news, except when you're fighting inflation. Strong growth means more spending, more hiring, and more upward pressure on prices. The labor market is tight, unemployment near record lows. Higher wages can fuel a wage price spiral, tough for the Fed to break. The Fed wants to see the job market cool, but it hasn't. Powell is caught, raise rates and risk recession, or wait and risk inflation. The economy's strength is both a blessing and a curse. The Fed's decision is more complex than ever. Every move is a balancing act. The data tempts another hike, but caution prevails. The Fed's tightrope walk continues. The outcome is uncertain. That's what makes this moment so fascinating. Want to know what the smart money thinks? Watch the 10-year U.S. Treasury yield. It's the benchmark for borrowing costs. Mortgages, corporate loans, everything. Recently the yield flirted with 5%, a level not seen since before the financial crisis. Higher yields mean investors expect inflation to stick around and rates to stay high. This spike has already tightened financial conditions, doing some of the Fed's work. That's why the Fed can afford to pause. The bond market's volatility signals deep uncertainty. If yields climb higher, stocks face headwinds. Higher yields make bonds more attractive than stocks. Rising yields push stock prices lower. The bond market is flashing a warning. The fight against inflation isn't over. The cost of money will stay high. The market's message is clear. Brace yourself. Amid the macro drama, corporate earnings matter. Over 80% of S&P 500 companies reporting have beaten profit expectations, proof of resilience. Strong earnings support the market, even as rates rise. But not every company is thriving. Estée Lauder's stock plunged 13% after slashing its outlook. The culprit? Weakness in Asian travel retail. A warning sign for the global economy. Don't just watch the averages, look at individual stories. Estée Lauder's pain shows global cracks beneath U.S. strength. The world is interconnected. Weakness abroad can hit U.S. giants. Earnings season is a roulette wheel. Some win, some lose. Corporate America is adapting, but risks remain. The market's resilience hides pockets of pain. Every earnings report tells a story. The roulette wheel keeps spinning. Watch for the next surprise. To see the full market picture, check Commodities and Currencies. Brent crude dipped 0.3%, a small move but a sign of easing inflation pressure. Lower oil prices help consumers and businesses, and may give the Fed confidence to pause. Oil's dip could also signal worries about global growth. The US dollar index slipped 0.1%, classic pre-Fed caution. A weaker dollar eases pressure on emerging markets and makes commodities cheaper abroad. But the dollar's been strong all year thanks to Fed hikes. Currency markets are betting on the Fed's next move. If Powell sounds hawkish, the dollar will surge. If dovish, it could drop. The currency market is coiled, ready to react. Oil and the dollar are key inflation signals. The world is watching both closely. Every tick tells a story. The next move depends on Powell. The world is on edge, waiting for the Fed's signal. Global markets are jittery. Europe down, Asia mixed, America uncertain. Only the Fed can provide clarity now. The Fed's decision and commentary will set the tone for months. Strong U.S. growth and tight labor complicate the Fed's job. Surging Treasury yields have already tightened conditions. Corporate earnings show resilience, but also weakness. Powell faces two paths: stay hawkish and risk recession, or pivot and let markets rally. If he's tough, expect higher yields, a stronger dollar, and falling stocks. If he's patient, yields may drop, the dollar could weaken, and stocks might surge. The world is waiting for Powell's cue. The next chapter starts now. Get ready for a wild ride. Booyah!